Hello, traders and investors. Steve Ganz coming to you from Kauai, Hawaii. And I've got a question for you and then a potential trade. So my question is this. If we take a look at our current market, is it time to put on a downside hedge? So what do I mean by that? Well, if we look at our current market, a case could be made that we are coming into a little bit of a resistance area right here. Now, last resistance area didn't hold. I would have thought for sure that this area in here certainly would have been a resistance area where our markets might have rolled over. They didn't. So I don't know if this one's going to hold or not either. But there's a couple things that lead me to think that it might. So if I take a look at a couple indicators here, one, we're hitting the Bollinger Band to the upside here, in addition to hitting that resistance area. Now, another thing is the volume is a little light on that last up day. It was a little lower than it had been previously. And then probably the biggest indicator maybe to me is the RSI, the relative strength indicator, which is sometimes an indication of overbought, oversold. If I look at this line, we can see that every time we have a peak in the RSI down here, we have a corresponding, what I'll call a temporary at least, top in the market. And we're getting back up to an area here where we're looking a little overextended, a little overbought. So if I feel that's the case and I want to maybe consider some sort of a hedge to the downside, possibly to hedge some of a long portfolio position, what are some of the things that I could potentially do to put in that hedge? Probably the most obvious one that people consider is simply buying a put. So let's just come in, we'll buy a long put in a major index like SPY. And if I come in and I buy that put and I can decide where is it I want this put? Do I want this put to be, do I want it to pick up immediately right here at 560? Or do I want it to come into play maybe a little bit lower, which means I'll pay less money for it? I have to keep in mind that if the market stays here or rips higher, I will have a 575 loss as this thing decays as time marches forward. Now, I'm looking here at this particular one. I'm looking at about 13 days out. I would probably go longer personally. I'd probably go out maybe almost 30 days, somewhere in that general range. Probably May 30th seems like a good one here. And because I think if the market's going to dip, it's going to dip within that amount of time. So taking a look at that, I can decide where do I want my hedge to be. Of course, the further down I go with this, it's going to give me less of a hedge. Let me get this back over here to it's going to give me less of a hedge, but at the same time, I'm going to pay less for it. My max loss, if I'm wrong, is a lot less. So I need to decide where that's going to be important for me to put that hedge. Do I want it right here at the money? In which case I'll make money if we dip even just a little bit, but my max loss is higher because of what I paid for that. Now, the way I personally tend to do many of these trades is I'll choose a point a little below where we're at currently. So my max loss would normally be 630 here. But if my thought is correct, if I look at this and I think, you know what, I really don't see us maybe going above this 5750 in the near future, I could choose a point up here and I could sell a call spread or even just sell a naked call if I have that ability in my account. And I can use that money to fund this trade to the downside. So let's just go and add, we're going to sell a call, and I can decide where I want to sell that call. So let's say I sell that call here, I'll go 575. So if I sell that call at 575, let me slide this out to expiration so it's a little cleaner to see. At expiration, if we stay below my break-even point here of 577, I will have profit in this trade. And I could, if the market were to sell off, I could actually have some significant profit in my trade, okay? In other words, if a big sell-off were to happen, that put is going to be gaining in value quickly. My short call that I sold is going to also be dropping in value, meaning that I can buy it back for a lot cheaper. So this is definitely a neutral to bearish position where I will make money if the market stays below, in this case, that 577 range. Anything below that, I'll be profitable. Anything below 575, I'll be profitable to the tune of $200 at expiration. If the market were to sell off considerably, I could have much more profit. Now, what if my account doesn't allow me to have a naked call? IRAs quite often don't allow that. I could come in and add a long call. So we'll come in here and we'll buy a call, and I can buy that call somewhere much higher here. So I can come out and I can buy a very cheap call, turning this into a spread. That's a pretty wide spread, but it does cap my max loss in the trade. It does still allow me to have profitability here. In this case, roughly $100 in profit if I expire anywhere in this range. And then, of course, if I go below the 550, that's when larger profits from that long put start to pile in. So this is a type of a hedge trade that I often consider doing if I'm in a position where I think our markets are a little overextended and might have a little bit of a stalling, because again, I'll make money if this stalls for 20, 30 days. I'll also make more money if the market starts selling off hard. Of course, I do have to be aware of this upside risk if the market continues higher, and I have to have a plan for dealing with that. In my case, my plan is often, if the market does in fact break to a higher point here, what I will many times often do is I may come in and just get rid of this long put that I bought. Let me just show you. I'll just exclude that for right now. And I might come in now and I might sell a put, essentially turning this into a straddle or something along those lines. I could, of course, buy a lower put, turning that into a condor. But if my premise is that we've broken to new highs here, and I'm not expecting this to fall back lower, it makes logical sense for me to go ahead and sell a put at some point that I'm comfortable with there, essentially turning this into a condor, straddle, strangle, something along those lines. So hopefully you found this of some interest. If you like this type of content, please do me a favor, give me a thumbs up, subscribe, give me a comment, give me a question, let me know what future topics you might like to see covered as well. Take care, everyone.